Trimothy Mu, Chief Asia Pacific Strategist at Goldman Sachs, joins us. Trimothy, good morning and fantastic to have you back. Trimothy, you've been bullish on Indian stocks and you've been dead right. But what do you make of the recent price appreciation? Too soon, too quick, and markets will have to digest the recent price appreciation, or it's going to be a one-way street going forward?
Well, markets are never a one-way street, and we've already started to see some correction or digestion of the gains in the last few days. So if you look at just the last 3 trading days for Nifty, we were up, I believe, 3% on Monday and then closed flat, and then we've kind of been turning around the last few days. So it's not, I don't think, surprising to see the market pause to regain its breath here for a little bit. If you look at some of the technical indicators in terms of short-term momentum, the RSI, for example, was up at 85, which is a very elevated reading just last Friday. So I think that there are a number of reasons to expect some sort of digestion of the gains while the market looks for the next confirmation of the positive broader story. And that's likely to be in terms of the immediate actions that the new administration takes, and also specifically in terms of the new budget, which would be deliberated and announced coming up next month. So I think right now we're probably in a little bit of a pause for breath digestion of gains phase. But I think the bigger picture to emphasize is that we think on a longer-term basis, on a 6 to 12-month view, that we think the market is still appreciably higher from here than it is currently.
Trimothy, so sectorally, what do you think is going to take the Indian markets higher? Where is leadership going to come in from? Because the last patch has seen cyclicals hold out.
Yeah, I clearly the cyclicals have started to move, but I still think that there is some catching up to do. I wouldn't say that all of that has been reflected in share prices, or put it this way, the fundamentals that we think will develop in terms of the economic cycle improving and corporate earnings beginning to recover in terms of the growth rate from this year into next. There probably is still more to go in the cyclical space in our view. So our general preference within the market still remains being overweight cyclicals and less optimistic on the defensives, or less weighted in the defensives, and then also trying to focus on beneficiaries of reform, which obviously is a well-flagged theme at this point.
Trimothy, if I look at the group which you normally associate your brokerage with, the institutional group, the data is not all that heartwarming. Post-election verdict, foreign institutional investors have been net sellers in Indian equities, and domestic institutional investors also have been marginal sellers. So if the Modi victory was so convincing, and if in the near term the uncertainty is out of the system, where are all the institutional investors? How come they are not putting their money where their mouth is?
It is a good question. I mean, overall, there has been net foreign buying in the Indian equity market, so certainly that is helpful. I think that, at least judging from a number of recent conversations that my colleagues and I have had with various institutional investors, I think people are asking the same sort of question that you just did, which is a very reasonable one, which is, look, we've had a very strong and powerful move in the Indian equity market. It's up, depending upon which day you measure it, close to 17% for the year. And, clearly in the short term, it's a bit on the so-called overbought phase. So our sense is a number of people are waiting and looking for opportunities to re-engage, but maybe taking their time in doing so. So I think if the market was to pull back a little bit from here, and we're not saying that that's our forecast, but it certainly would not be an unreasonable thing to see occur. Our sense is that there's a fair amount of money that's waiting on the sidelines looking for an opportunity to re-engage. So we wouldn't really be too overly concerned that in the last few days we haven't seen as strong a presence of institutional buying as one might ultimately expect and hope for.
Trimothy, but has the low-hanging fruit been plucked when it comes to Indian equities? Do you think 7,500 and the top was 80% of the rally done, or do you think there is significant more upside left in the markets?
Well, as we indicated in a recent report that my colleague Sunil Cole and I authored, we think that our 12-month target for the Nifty is 8,300, which, as of yesterday's close, is about 11% higher than here. We published a report. We had 15% upside, but the market has had a nice appreciation just in the last few weeks since the announcement of the election victory. So we still think that there is some meaningful appreciation that can occur. And I think there's also could be upside to those numbers. In other words, the target that we have is not an outlandishly constructed one. It's not as though we put everything in the proverbial shop window. And to be specific about that, I think that there could be some further room for upward revision of consensus earnings estimates. As we've noted in our recent work, we're starting to see some positive revisions on balance by domestic analysts as they begin to factor in a more favorable fundamental outlook and policy outlook into their earnings forecasts. And then, of course, the valuation target that we have used for that 8,300 Nifty target is 15 times earnings, which is actually a little bit lower than where we are today. So we've been, we think, quite level-headed and possibly a bit conservative in our aggregate valuation forecast. And to refresh your memory, the Indian market has traded on average about 15 times over the last 10 to 15 years, but it has reached peaks of 22 plus times earnings. Now, we don't think that obviously would be an extreme. We're not calling for that. But in an environment where we have a cyclical upturn and where you have the kind of significant change from a leadership and policy perspective that we currently have, it would not be unreasonable to see the market having at least some moderate further valuation expansion. So we haven't baked that into our numbers. So if you wanted to get more optimistic and have maybe a 16 or 17 times target multiple and a little bit higher earnings, you can do the quick math on that, but that could lead you to maybe mid 8,000s or even high 8,000s on the Nifty, which could still be appreciably higher than it would be like mid-teens to high teens upside from here. So we're not making that our base case forecast, but certainly would not be unreasonable to think that there could be some further upside there. So I think the general view that we feel comfortable with is that there still is clear fundamental upside for the market. Short term, we're probably a little bit extended, and we need to have some digestion, consolidation of the gains, and maybe some further news flow to verify and consolidate things. But we could still go higher.
I mean, Indian markets are trading at about 14, 15 times. We are in line with the average range, and if indeed a bull market has started, stock prices, they will move up and earnings will catch up. So I'm with you when you make that point. But just to recycle an important report which Goldman Sachs released about 6 weeks ago, a big buy call on PSU Banks. When I read that report, my first reaction was, is it a brave call? Well, it was not a brave call, it was a great call. Are you still of the view that PSU banks have a long way to go? Because when I've interacted with some of the PSU bank chairmen, they are of the view that NPS is still a concern.
Yes, and this I think is a significant debate, and I think the PSUs I think would be a specific example, in fact probably a very targeted and almost marquee example of the larger question you've asked about the overall market, which is really the intersection between recent price performance, the fundamentals, and the expectation and how things may turn out. And to be more specific about that, we obviously have seen some very pronounced share price appreciation as the market has gone from a quite cautious fundamental view to pricing in a greater degree of confidence that there will be a cyclical improvement and that fundamentally that will pass through into perhaps less credit stress that was previously feared for the PSU banks, and then a corresponding improvement in their valuation. So there's no gainsaying the observation that the banks are the sort of the entry point for them from a share price standpoint is less attractive now than it was with the benefit of full hindsight 6 weeks ago. Now, as you correctly said, I think the real crux of the issue here is what happens in terms of the credit cycle, because that will be the big delta, the big change in terms of how the fundamentals for the banks pan out. Now, I realize I'm speaking with a broad brush, and one has to go and look more specifically at each particular bank, but I guess the general flavor of our view on the credit cycle is that there are a reasonably large number of assets, of course not all, but a reasonably large number in the infrastructure space and the investment space where the assets are stressed not necessarily because the businesses are bad businesses, but because they've been constrained in terms of their operations and their cash flow by constraints in terms of either project approvals or other kinds of required administrative approvals. Now, if there is some ability to address those in a timely manner, and that, of course, is what the market and we are expecting in terms of